Thank you, Dr. Weidmann, Jens, for this invitation, the Bundesbank for putting on this important conference. It's a great honor to be here. I'm not sure the fog will have lifted by the end of my remarks over the next 20 minutes, but I do want to touch on some of the most important issues with respect to financial stability and FinTech. It's an honor to be in the presence of you, Minister de Maizière, and thank you, and I look forward to your remarks shortly, and the Treasurer Scott Morrison as well. So it's an impressive gathering after me and before me, and I will try to fill in a bit in the middle. A few hours ago, I was in the fog, but I was also in the world's leading FinTech center, a center that generates £6.5 billion in revenue, attracted more than $500 million of new investment in 2015, employs over 60,000 people. And what's happening is, whether it's the startups in London or in Transistor Berlin, all the way to more established players in Silicon Roundabout, in Silicon Roundabout in London or in Transistor Berlin, or to the more established players in Silicon Valley, entrepreneurs are applying their creativity and technical ingenuity to the financial services value chain. And to the advocates, this wave of innovation promises nothing less than a FinTech revolution that will democratize finance. Some of the promises are pretty strong. Consumers will get more choice, better targeted services, keener pricing. Small and medium-sized enterprises will get access to new sources of credit. Banks will become more productive, they'll have lower transaction costs, they'll have greater capital efficiency, and they'll be more resilient. And the system itself will become more resilient with greater diversity, redundancy, and depth. And most fundamentally, at the heart of this conference, Majesty, and the heart of your work, is that financial services can become more inclusive, with people better connected, more informed, and increasingly empowered. And the fact is that with hundreds of millions of people now entering the digital financial system each year, it's possible that we could take this quantum leap in social equity and also with it move to higher growth. But equally, we have to ask ourselves the question whether the range of innovations that are happening, whether those technologies will primarily make existing firms and markets more efficient and effective. Now, there's a long history, of course, of technological innovation being twinned with finance. The modern system is the product of things ranging from the simple ledger in the 15th century, the advent of the telegraph in the 19th, ATMs in the 1960s, online banking and brokerage towards the end of the last millennium, and the rapid rise of mobile banking since. But despite all those technologies, despite all those advances, it's fair to say that finance continues to be arranged around a series of hubs, like brokers, clearinghouses, and exchanges, whereas in other domains, people are increasingly forming connections directly, instantaneously, and openly, and that is what's revolutionizing how they communicate, work, and live. So the extent to which finance could be similarly redrawn depends on the application and connection between superficially arcane but fundamentally vital enabling technologies, including mobile telephony, the internet, high-speed computing, advances in cryptography, and innovations in machine learning. And the true promise of FinTech springs from its potential to unbundle banking into its core functions of settling payments, performing maturity transformation, sharing risk, and allocating capital. And this possibility is now being driven by new entrants, payment service providers, or PSPs, aggregators and robo-advisors, peer-to-peer lenders, and innovative trading platforms. And of course, will be influenced by those incumbents, whether they're institutions or markets, and how they take the technologies and try to reinforce their existing economies of scale and scope and protect their business models. In this process, systemic risks are evolving. Changes to customer loyalties could influence the stability of bank funding. New underwriting models could impact credit quality and even macroeconomic dynamics. New investing and risk management paradigms could affect market functioning. And a host of applications and new infrastructures could reduce costs, will probably improve capital efficiency, and could possibly create new critical economic functions. And the challenge for the policymakers, the front part of this magnificent hall, if you will, the challenge for us is to ensure that FinTech develops in ways that maximizes those opportunities and obviously minimizes the risks. Because after all, the history of financial innovation is littered with examples that led to early booms, growing unintended consequences, and subsequent busts. And that's why, at the request of the German presidency, the FSB is now considering the most important financial stability issues associated with FinTech and drawing on a stocktake of national approaches, assessing the extent to which these risks are being addressed by the existing regulatory frameworks. And Carolyn Wilkins is here, who's leading that work for us. We intend to report the findings of this work to the July summit as part of the broader effort of the German presidency and the G20 to promote those objectives for financial inclusion and strong, sustainable, and balanced growth. So in that spirit, what I'd like to do with my remaining time is to highlight some of the potential financial stability issues raised by the FinTech revolution. But first, I'm going to make a confession. I was a banker once. Not a vampire squid, but I was a banker. Back in my native Canada, to earn money for tuition, I was a teller at a bank, or more precisely, I was a customer service representative. And I thought, when I got the job, I thought, well, I'm a teller, but why would they call me a customer service representative? And I eventually learned the reason behind that, because my primary responsibility back in the 80s was to stand at a wicket like this and accept deposits and pay out withdrawals, mainly from small businesses. Over time, I got to know the regulars, from the baker who would come in every afternoon with, a big wad of cash that smelled of bread, literally, literally dough at the time. So I got to know him, and I also got to know the executives of what was a failing construction firm who used to cash their weekly paychecks with alacrity and trepidation until they could no more. And I learned that also that there were two types of clients, those who engaged with me and those who didn't. And after a while, I figured out that the former, those that engaged with me, got more from the bank, because I and it knew more about them and what they needed, whether it was a savings product or a loan. And the bank also got more from them, both in terms of revenue and reliability. And that reliability was helpful because actually at that time, a couple of banks had failed in Canada. Banks have failed in Canada. Don't let all my colleagues tell you that banks never fail in Canada, because they had failed in Canada in the 80s, and reliability and stickiness of the customer mattered. In fact, the province I was in at the time was going through a deep recession, so loyalty and understanding mattered. On the other direction, it meant the difference between a restructured loan that could be repaid and a foreclosure that would bring liquidation. So in short, with that backdrop, I was at the front of, or towards the front of, the banking value chain. And it's that value chain that I'm going to sort of take apart that's now being impacted across its components by FinTech. Traditional universal banks combine that customer relationship with retail and commercial deposits and lending, and a wide range of activities in wholesale and capital markets. And on top of that are payment services, and where payment services once relied on cash, credit and debit cards, and wire transfers, FinTech companies are now providing domestic and cross-border payment services through digital wallets and e-money. These firms take a slice of the payments revenue, a standard business model, and in many cases, they also take the totality of customer transaction data. In the process, they're systematically capturing the type of knowledge that I used to somewhat more haphazardly gain from my daily interactions with customers in the bank branch. And those providers are leveraging that data, not just for banking reasons, but principally to sell non-bank products and services. And that business model, and truth be told, the desire to avoid the burden of regulation, reduces their incentives to integrate upstream into the formal banking channel. So they're outside of the regulatory perimeter. The more traditional universal banking relationship begins with what I used to do as a teller, so that customer relationship. And this historic preserve of banks is now being opened up. Aggregators using banks' APIs are providing customers with ready access to price comparison and switching services. And meanwhile, so-called robo-advisors are deploying algorithms to deliver affordable investment advice to retail customers. Now, other fintech players are increasing competition further up the value chain in retail and commercial banking by providing new lending and borrowing platforms to retail and corporate customers. In a number of G20 countries, new business models are drawing on big data and advanced analytics to tailor products and to discipline underwriting. For example, in the UK, peer-to-peer lending now represents about 14% of all new lending to SMEs, and our estimates suggest that more than half of that would not have been provided by traditional banks. Other platforms are allowing firms to borrow against receivables much more quickly than traditional factoring, using the data that's drawn directly from the software that their customers use to manage their accounts payable. I would say German software that their customers use to manage their accounts payable. Some of the more radical innovations are underway in emerging markets. As many of you know, e-commerce platforms in China, for example, use algorithms to analyze transactions and search data to improve credit scoring. And this has resulted in a significant expansion of credit availability with very low default rates, albeit ones that have not yet been tested by an economic downturn. In wholesale banking and markets, the direction of travel over the last few years has been from intermediated trading to non-intermediated electronic order-driven trading, where those securities are traded electronically, such as over exchanges. Such algorithmic trading has grown rapidly from small bases up to about 40% now of FX trading volumes and up to 3/4, depending on exchange, of equity trading volumes. And finally, the last end of the value chain, technology which goes outside the universal bank, but to the wholesale payments, clearing, and settlement infrastructure. There's a host of emerging technologies. One of the most interesting is distributed ledger, which could, in future, and I'd put the emphasis on future, offer significant gains in accuracy, efficiency, and security of processes across clearing and settlement, as well as potentially better regulatory compliance in that process, saving potentially tens of billions of euros in capital. Now, I'm going to go a bit more into the financial stability implications of all this, but just before I do, I just want to touch on three broader public policy issues because, first, they're important. Secondly, the extent to which they are addressed will influence the extent to which certain technologies truly transform the system. So there's broader issues that have to be considered, obviously, away from financial stability. The first is simple. It's simple to say. I'm not going to go into details because it's tough to do, but a host of conduct issues associated with these products, as with any new product and service, and also how they help or hinder anti-money laundering and combating the financing of terrorism. And I think we'll hear some more in a moment. Secondly, there are twin imperatives of greater inclusion and more competition, and both of those, individually but certainly collectively, reinforce the value of digital identities. Billions of people are still underbanked or unbanked across the world, and we also have a situation where, as the FSB is stressed and Svein is here, some countries are at risk of being cut off from the global financial system as major correspondent banks withdraw. Both of these are different aspects of the identity issue. Now, a host of new technologies, not limited to, but including biometrics and cryptography, are providing solutions to facilitate access to the financial system and reduce, amongst other things, AML and CFT compliance costs. Since and the advances in inclusion are truly impressive. I think it bears repeating the progress that's been made in India, where more than 800 million such identities have been issued, and at least four out of 5 citizens can now use them to make use of governmental and financial services. Seizing the full potential, so it's one thing to be included, but the point I was going to make on a broader public policy is that seizing the full potential of such opportunities requires a careful consideration of fundamental rights of privacy and practical constraints on storage and handling. Ultimately, it's obviously for governments and citizens to decide where and in which cases the benefits outweigh the costs. And the third public policy issue I wanted to flag is related, which is a series of fundamental issues that exist around data protection. And I want to draw a distinction between what financial institutions traditionally do and what technology companies in general or social media does. Financial institutions have protected and used their customers' data under well-established legal and regulatory frameworks. In contrast, social media firms regularly collect and often share much more extensive data from their users with their consent, it must be said, with the ticking of the "I've read all conditions" box. But given that the FinTech future envisions the gathering of a broad range of financial and non-financial data from and the sharing of that data across a wider set of parties, I suggest a more intense debate can be expected about whether there are appropriate frameworks for the gathering, storing, and sharing of such data, both domestically and across borders. So with that I'll turn to the financial stability risks and give a bit of a sketch of some of the way that we individually and collectively at the FSB think about them. And the first is to make use of our existing frameworks for evaluating risks that affect banks, insurers, financial market infrastructure, shadow banking, or so-called market-based finance. In other words, our starting point is that there's nothing new under the sun. So what is a financial activity? Identify the activity and have a consistent approach. We have to be disciplined about having a consistent approach to similar activities that are undertaken by different institutions but give rise to the same financial stability risks. Just because something's new doesn't mean it necessarily should be treated differently. And similarly, just because it's outside the regulatory perimeter doesn't mean it has to be brought in. So some of the most important questions that we're considering, and I'll list four, include which FinTech activities constitute traditional banking activities by another name and should be regulated as such. And as a general principle of the FSB's shadow banking roadmap, which was catalyzed by the German presidency, those systemic risks are associated with credit intermediation combined with either maturity transformation, leverage and or liquidity mismatch, and that those should be consistently addressed regardless of the delivery mechanism or credit algorithm. The second question is, how could developments associated with FinTech, how could those developments change the safety and soundness of existing regulated firms, particularly those that are judged to be systemic? And what supervisory response should there be for those firms, in other words, the regulated firm, not the FinTech firms? What should that response be? Third question is, how could developments change macroeconomic and macro-financial dynamics, including how could they affect systemically important markets? And lastly, there are a series of very important questions around the aggregate level of cyber and operational risk in the financial system. So just to draw out a bit some of those issues, I'll return to my value chain there. And starting at the top with respect to payment services, I'd stress that currently most of these issues are in the domain of the conduct regulators. And that's because, at least in advanced economies, as I was saying earlier, most of these payment service providers aren't integrating backwards into banking activity. And none of them are yet, would appear, at least from where we sit, to be of a scale that could be considered systemic in and of themselves. Now, if you look ahead, it's possible that virtual currencies and PSPs could begin to displace traditional bank-based payment services. To some extent, that would be positive, but if it goes too far, then you get to single source risk. And in the latter regard, at least in the UK, with an eye to future-proofing, the Digital Economy Bill proposes to extend the definition of a payment system to beyond the interbank in order to create the ability to designate future systemic payment systems that would be outside the banking system and which would then be supervised by the Bank of England, just as we supervise now the major credit card providers. Moving up the chain, those changes to payments that I just referenced and also to customer relationships may have bigger effects for financial stability, if you will. This is my second question about how does it affect existing institutions. So FinTech may make conventional banking more contestable. That improves efficiency, it improves customer choice, but by opening up the customer relationship, it may mean the end of universal banking as we know it. If today's universal banks lose the loyalty I saw in the Canadian prairie a few decades ago and instead have less stable retail funding relationships and weaker arm's length client relationships, the volatility of their deposits and the scale of their liquidity risk could increase. In addition, with weaker customer ties and less information, cross-selling, my old preserve as a teller, could become less prevalent, hitting profitability. Now, the system as a whole wouldn't necessarily be weaker in this case, but prudential standards and resolution regimes for those banks may need to be adjusted as they shift towards utilities. With respect to competition in retail and commercial lending, at present, the peer-to-peer sector doesn't, for the moment, appear to pose material risks. But as a general rule, when things are growing rapidly, and I'm not speaking rapidly enough, apparently, according to the president, when things are growing rapidly, you should pay attention. So I will pay attention and try and speed up. But it's not clear the extent to which these P2P business models can continue to grow at current paces without adjusting their funding models somewhat and starting to take on more conventional banking risks. In the wholesale markets, I think President Weidman may have touched on this, looking at robo-advice and risk management algorithms, we do need to think about how they affect market dynamics and liquidity. And finally, with respect to payment clearing and settlement infrastructure, I won't go into great detail, but just to say on distributed ledger, while there's potential promise there, they have to meet the highest standards of resilience, reliability, privacy, and scalability. And for all of these firms, the advent of, or all of these activities, I should say, the advent of FinTech materially changes operational and cyber risks, and we need to up our game in that regard, and that's one of the reasons why it's welcome that, again, under the German presidency, they have called on us to take a stock take of existing cybersecurity regulation as a basis for developing best practice in the G20 over the medium term. So let me conclude. First, FinTech appears to be everywhere. From media citations to conferences, it's going through the roof. But we need to ask ourselves where we are in the cycle, from the original trigger of the new technology to the peak of inflated expectations to the trough of disillusionment onto the ultimate productivity plateau. The question is there something new under the sun? The achievements thus far are impressive, particularly the enormous improvements in financial inclusion. And I salute, again, the work that has been done and the ambition that is behind it of Her Majesty. Moreover, there are clear prospects in our world for new financial technologies to make the system more efficient, more effective, and more resilient. But the biggest prize may be from FinTech's potential to combine seamless real-time payments with distributed commerce, more sophisticated client targeting, more accurate credit scoring, and the greater extent to which this can be realized, it creates the ability for finance to support the type of creative jobs that people will need and enjoy in the machine age. The role of authorities is to some extent to help enable these changes, which will be purely or largely driven by the private sector, but also obviously to manage the associated risk to financial stability. It will require, and I'm finishing with this, a few refreshments, in our opinion, to our supervisory approaches. The first, with respect to regulatory sandboxes, I'm sure it's been discussed and will be discussed, ways of allowing businesses to test innovative products, services, and business models in a live environment with a proportionate, initially proportionate regulatory requirements. The FCA was, in the UK, was an early mover on this with Project Innovate, and the G20 might consider the extent to which this could be applied more broadly. The second is being alert to using existing authorization processes for banks, remove unnecessary burdens there. The third is to actually expand access, start to expand access and open up the central bank balance sheet to non-bank payment service providers. The Bank of England has made that announcement, and our thinking is that by allowing access to our real-time gross settlement, our large value payment system, that will help the largest PSPs compete more directly with banks, and that will support innovation, competition, and because they will be subject to a higher standard in order to do that, it will also support financial stability. And fourth, a number of authorities represented here, including the bank with our FinTech accelerator, are developing proof of concepts with new enabling technologies ranging from machine learning to distributed ledgers. In the extreme, we're also exploring what could be genuinely new under the sun, which is looking at the research and technical issues associated with central bank digital currencies. On some levels, it's appealing. This would be appealing because it gives people ultimate access, or access to the ultimate risk-free asset. It's democratic in that regard as well. Of course, in the extreme, it would fundamentally reshape banking, including by sharply increasing run risk for traditional banks. So I've argued today that in order for FinTech's promise to be realized, we will need to manage its impact on financial stability. We recognize that it reduces risk to systemic stability by making the system more diverse and resilient. But at the same time, many innovations have the potential to generate systemic risks through increased interconnectedness and complexity, greater herding and liquidity, and more intense operational risks as well. As those risks emerge, expect us to have a more intense focus on where the regulatory perimeter is, a more dynamic setting of prudential requirements, a tougher commitment to resolution regimes, and a more disciplined management of operational and cyber risks. But if we can do that, while enabling these technologies, we can help create a new financial system for a new age. In other words, something new under the same sun. Thank you very much.